Welcome to today's live stream. Welcome to today's live stream. Welcome to today's live stream. Welcome, guys. Let's wait for the numbers to come up a bit. So while we are waiting for other people, before we start, what we have for today. Sorry, hold on. Before we start on the business for today, I would love you guys to share this to your WhatsApp story. Your WhatsApp status, let people be aware of it, that we are live right now. Share it. Just go share. And then let's wait for the numbers to go up a bit so that we can start. I don't want to leave anybody behind, so nobody comes later and start asking me questions I've covered previously already. So go on, share this, hit the like button. If you're not yet subscribed, subscribe to the channel, so that this video can be recommended to as many newbie traders that are willing to learn what forex is. So for those of you who might be new, maybe you don't know me, let me introduce myself properly. I'm Lightman Chimso, and you're welcome to Light on the Chats, where I'm all about simplifying your forex journey as a trader. I'm all about simplifying your forex journey. So this particular topic, we have covered it last week, right? Okay, 2 weeks ago. But due to your country, I know your country and network issues, so we have to shift it. That was last week, and same issue occurred network, and trust me, that's why we're having this class today. So we're going to be having the class today, market structure and key levels. That is what we're going to be covering today, market structure and key levels where price matter. So I would love you guys to hit the thumbs up, share to your various status, and also let me know where you're joining me from. Hit in the chat box. Let me know where drop your locations. Let me know where you're joining me from. I'm currently at GRA for Harcourt, Nigeria. Let me know where you're joining me from. Drop your locations in the chat box. Keep the locations coming in. Let me know where you're joining me from. Let me know. Good evening. And people are already greeting. Good day. All right, let me know where you're joining me from. Drop your locations in the chat box. Let me know where you're joining me from. Let me share to my story, and I'll be back with you guys. So you guys make sure you share this too as well. Let me share this to my story. Let me share this. So you guys make sure you share. Let people be aware of it, and then let's come back and dive into the business of today. Let's dive into what we have for today. Today is really loaded, guys. And I'm ready. I hope you're ready. Someone said it's joining from Ada George Port Harcourt. Okay, Ada George Port Harcourt. Nice to meet you, blessed. Nice to meet you. Drop your locations in the chat box. Let me know where you're joining me from. Drop your locations in the chat box. Let me know where you're joining me from. Keep the locations coming in. Let me know where you're joining me from. Let me know where you're joining me from. Okay, so for those of you who might be joining in here, my name is Light. My James, I said that earlier, and you're welcome to Light on the chat. So today, let's dive into the business of today properly. So today's class is going to be about two things basically. Today's class is going to be about two things. One, market structure, that's what we're going to be covering, and second one is key levels. So as a trader, market structure is one of the most important things you're supposed to know as a trader. So that's why this class is very, very important. If you don't understand this class, then you shouldn't be trading at all. You shouldn't be even trading at all. So that's why this class is very important. So before we start, I would love to know if you can hear me clearly. Drop number one in the chat box. If you can hear me clearly and you can see me clearly, drop number one in the chat box. Drop number one in the chat box. Let me know. Drop number one. Drop number one in the chat box. Okay. All right, for hackers, that's good. Drop number one in chat box. Drop number one in chat box. I can see locations coming in. Okay. So you guys can hear me clearly. Quick roll. All right, for hacker, that's nice. Drop number one in the chat box if you can hear me clearly. So we move on. Okay, number one. Okay, you guys can hear me clearly. All right. So today we're going to be talking about market structure and key levels, like you all know already. Yeah. So first off, we're going to be starting. What is market structure? We're going to be talking about market structure. We're going to be talking about market structure. Yeah. So what is market structure actually? What is market structure? So market structure refers to the way price moves and how it organizes itself on the chart, right? Or in the chart over a series of time. So it's the foundational concept in price action trading. Like I said, if you don't understand market structure, then you shouldn't be trading at all. You shouldn't be trading at all. So that is what market structure is all about. So we have key components of market structure. Don't worry, this class is going to be both theoretical and practical. So whenever I tell you something, I'm going to take us to the charts and then explain exactly what I'm talking about. So you might not get it while I'm explaining, but then when I take you to the charts, you guys would understand properly what I'm talking about. So market structure refers to the way price moves and organizes itself on the chart over time. So now we have key components of market structure. That's the next thing we're going to be talking about, the key components of market structure. So what are the key components of market structure? We're talking about higher highs, higher lows, lower highs, lower lows. These are the key components of market structure. That is what market structure is that's what market structure contains. Higher highs, higher lows. Don't worry, this will definitely make sense over time in the course of the class. It definitely makes sense. And then that takes us to the next step, which is types of market structure. So now, types of market structure. We have the bullish market structure, which is also known as the uptrending market structure, and the bearish market structure, which is known as the downtrend, and the ranging or sideways consolidation market structure. So we basically have three different types of market structure. Three different types. We have the bullish uptrend, bearish downtrend, ranging or consolidating, which is also known as sideways. That's the kind of market structure we have. Three different types of market structure. Okay, so let me share my screen. Let me take us to the chart so you guys get to understand what I'm talking about. Let me take us to the chart. If you can see my screen right now, drop number 2 in the chat box. If you can see my screen right now, drop number 2 in the chat box. If you can see my screen right now, drop number 2 in the chat box. You can see my screen, drop number 2 in the chat box. Before I move on, I want to make sure everyone is carried along because this particular topic has been long overdue. So we have to cover it fully and in its entirety today. Okay, so you guys can see my screen. All right. So let's move on to the charts. So now we are entering into the practical aspect of things. So now, what I was talking about when I said the components of market structure, right? When I mentioned the component of market structure, I talked about a few things, right? I talked about higher highs, higher lows, lower lows, and lower highs. Where is the diagram I drew? Okay, you can see it right here. So don't worry, this is just a rough drawing so that you guys get to understand before I take you guys to the charts proper. So you can see this diagram right here, this black diagram right here. It's the bullish market structure, which I said uptrending market structure. So the direction already tells you the way the diagram is positioned. It's already telling you that it's uptrending. You can see it comes up, gets here, it drops, gets here, becomes higher than this one, it drops like that. It's just going up in like a wave-like manner. So that is how market moves. That is how price moves in waves. goes up, comes down a little, goes up, comes down a little, goes up, comes down a little. So now this is the bullish market structure. And now when I mentioned earlier about the components of market structure, this is what I was talking about. The higher high, the higher low, a higher high, a higher low, a higher high, a higher low. Now, why it's called higher highs and higher lows is because this high right here, this is a high, and this high, right, it's higher than this high right here. So this, therefore, it's a new higher high. And if you keep on, market keeps on pushing, this high is higher than this previous high, right here. So that is why it's another higher high, and this high is higher than this previous high. So therefore, it's another higher high. And then the bottom right here, this is a low, right? Price push creates a new high, drops a higher low. Now, this low that we are seeing at this bottom right here is higher than this one here. So therefore, it's called the higher low. Hope you guys understand. If what I've said so far makes sense to you, drop number 3 in the chat box. If what I've said so far makes sense to you, drop number 3 in the chat box. Drop number 3 in the chat box. This guy say like and the fucking shots. If what I've said so far makes sense to you, I move on. I want to make sure everybody's understanding. Drop number 3 in the chat box. Drop number 3 in the chat box. Drop number 2 in the chat box. If what I've said so far makes sense to you, okay, three. Just drop number 2 in the chat box. If what I've said so far makes sense to you, just drop number 3 in the chat box. Drop number 3 in the chat box. Drop number 3 in the chat box. Drop number 3, number 3, number 3. Drop number 3 in the chat box. What I've said so far makes sense to you. Okay, it's making sense. All right, so let's continue. So now, when price moves in waves, like I said, like you can see, pushes like this, drops a little, pushes again, drops. This first move that creates new highs is always larger than this one that creates the lows. So therefore, this first move right here, it's called an impulsive move. This long move you can see right here, it's called an impulsive move. And this move, this smaller move, is called the corrective move. So that is how market structure is all about. That's what it's all about. This first move is called an impulse, corrective, impulse, corrective, impulse, corrective, impulse. So that is how price keeps on trending, goes up, gives an impulse move, a corrective move, gives an impulse, a corrective move, give an impulse, a corrective, and so on and so forth until the market structure changes. Yeah, until the market structure changes. So currently you can see it's uptrending, gives impulse drop, like that, creating new highs, higher than the previous highs it created, and higher low. So that is it for bullish market structure. And then now inside this market structure, if you remember when I talked about time frames in the previous class that we had, I talked about time frames are just different representation of the story the market is telling us, right? So now you can see this is an impulse, this is a corrective move. Now if you look into this impulse move, you could see this this red, like this one I drew with red. This is another market structure inside the impulse move. Don't worry, but I'll take us to the chart so we get to understand what I'm talking about better. Now it creates a high, creates a higher low, creates another high inside of this impulse move. And then when it drops too as well, this impulse move now becomes a mini downtrend inside a bullish trend, inside an uptrend. It becomes a mini downtrend before it continues, the uptrend continues again. So now that is basically how market structure, or what it's actually all about. So now in the bullish market structure, in bullish trend, in uptrend, what we are supposed to be doing as traders, we are supposed to be buying. Like we say, the trend is your friend. You're supposed to be buying, not trading against the trend by selling. You're supposed to be buying during an uptrend and selling during downtrend. So I'm going to be explaining that. So the next trend we're going to be talking about, is the ranging or consolidating trend or sideways trend. Now you can see the market is basically ranging. It's not doing anything. What we mean it's ranging, it's just stuck between here, this point, and this point. It's not breaking out, sir. It's not breaking below, it's not breaking above. So that is what ranging market always just goes sideways, goes up, comes down, 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 just like that. There's no true direction. You can see it's just going sideways, creating higher highs than the previous high, come back, create a higher low, go back, come back, create a lower, like just create like a lower low, lower than the previous low. Just so it's just scattered. And in this kind of market, as traders, we're supposed to be staying out of the market. You're not supposed to be doing anything. You're supposed to be staying out of the market, not doing anything, right? You're not supposed to be doing nothing in the market. You're not supposed to be doing anything as traders. You're just supposed to be staying out because the market has no true direction. So you're supposed to be staying out. But then there are some advanced strategies that actually enables you to trade the ranging market. But that is not for today's class. It's for another class. Maybe as we advance in the live session, maybe we'll get to cover that. Yeah, ranging market. Yeah, someone said ranging. It's just going sideways. It's just going sideways. Ranging. So back to what we're saying. It's consolidating. It's just ranging. Gets here, just comes down. Just no true direction. So that's what ranging market is all about. And then the next market structure we're going to be talking about is the bearish market structure. Bearish market structure. Bearish market structure. So we are going to be talking about the bearish market structure. Let me zoom in a bit. Let me zoom in a bit so that we get to see. So now, okay, wait, let me go to a different time frame so that we get to see it when I'm zooming. So now we're talking about the bearish market structure. Right here. Now, bearish market structure, you can see it's the opposite of the bullish market structure or the uptrending market structure. You can see, I don't know if you're following me up until now, what I'm saying makes sense to you. Drop number 4 in the chat box. Drop number 4 in the chat box. Drop number 4 in the chat box. What I'm saying, yeah, also called accumulation. Yeah, the ranging market is also called accumulation. It's just accumulating, no true direction. So currently, if you've been following me up until now, drop number 4 in the chat box. Drop number 4 in the chat box. Drop number 4. This guy is active. This guy is active. These guys are active. They are active. Drop number 4 in the chat box. Drop number 4. Drop number 4. Drop number 4 in the chat box. If you follow me, okay. So that's good. That's good. You guys are actually following. So now let's continue. Now we're talking about bearish market structure, or the bearish trend, or the downtrend. Now you can see it's the opposite of the bullish trend right here. Now you can see price drops, create a lower high, drops, create a lower low, versus goes create a lower high. Now why this is called the lower high? It's because this high right here is lower than this previous high. So therefore it's called a lower high. Drops again, create a lower low, which is lower than this previous low. Goes up a bit, creates a lower low, a lower high rather, and then drops, create a lower low, and so on and so forth until the structure changes. So that is just basically what market structure is. Understanding what what the market is saying at a particular set of time. Like I said, we're talking about two things. Market structure tells us the direction of the market, and then key levels, which we'll cover later, tells us the location of where things is actually happening in the market. So that is what this class is all about, telling us the direction. So by the end of this class, you should already know. You should open the chart and know the direction of the market. By the end of this class, you should open the chart and know, okay, this, you should know the market structure, what is currently happening, the direction at which the market is currently moving in by the end of this class. So you can see now, if you look into the bearish market structure, right, you can see this long move right here is an impulsive move, like I said, but in the bullish market structure, this massive move is an impulsive move, and this one right here is a corrective move, impulse move, corrective move. Now let me explain why market moves in waves, right? The market doesn't just go like in a straight direction, like it doesn't just move in a straight direction like this and keep just comes down, correct, goes back. That's how market moves, right? Now, what causes this is now for an example, in an uptrend, right? People buy from here, and once buyers are in the market, what happens? Demand increases. Okay, let's take an instance. Let's say you're booking here, right? And demand is high, right? People are booking rides. Maybe for example, a rainy day, and people are booking rides. You see that normally price is supposed to be around, let's say 2K. That's the price at 5K. Demand is high because people are booking and people are booking and people are booking. So that is it. Now, once buyers step into the market, let's say for example, this price right here is 100 naira here, and then buyers step into the market. Once buyers step into the market and start buying from the seller, because the rule of trading is for there to be a buyer, there must be a seller. In order for you to sell, there must be a buyer willing to buy. So now the sellers are in the market, buyers comes in and buys into the market. Now, when they buy into the market, since the sellers are sold, what happens? Sellers reduce the number, price gets high. For example, you want to get this in the market. Let's say you want to get like 1,000. Let's say there's 1,000 pieces of this in the market, for example, and they've already bought, let's say, 700 pieces of this, remaining 300 pieces. What would the sellers do? The sellers, like, what would they do? Price will go up, right? Price will go up because it's few now, and people are, rushing. There's a lot of demand for this particular thing, so price will definitely go up. So that's what happens. So price goes up right here, push to the side, buyer step and push price up. Now, when it gets here, what are they doing? Most of the buyers are closing their trade positions. So once they're closing their trade positions, buyers are reducing in the market, and now sellers are now stepping into the market, and sellers now push price down to a price that buyers now see comfortable. For example, this is supposed to be sold at 100 naira, and you want to buy it, and maybe you now come to the market and you see that price from 100 naira, it has gone to like from 100 naira, it has gone to like from 100 naira, it has gone to like 1,000 naira, and you be like, nah, I can't buy it at 1,000 naira. Let me wait for price to drop a little. So that is what the corrective move is about. This corrective move right here, that is what it's about. So it's about some buyers waiting for price to drop a little so they can buy. So now that's what happens. Now buyers get here, they take profits, right? They close their trade positions, leave the market because they bought. And now sellers now step into the market and push price down. When they push price down, buyers see this price as comfortable. Okay, it's now comfortable. Maybe from 1,000 naira, it now drops down to like, let's say it drops down to like 400. Some buyers will not be like, okay, I feel this is the lowest it's gonna come. It's not gonna, it's not gonna come lower than this. It's never gonna get back to 100 naira. So now it's at 400. Let me just buy it. Let me just close my eye and buy it. So that's what happens. Now more buyers step into the market again, push price up once more than this previous place where previous buyers stop. Now more buyers step into the market. Now they close their trade positions, sellers step in again. Now this is the corrective move again. Now more buyers feel that, oh, currently now it's at 700 naira. I feel it's never going to get back to 400 naira or 100 naira again. So therefore, let me buy it right now. And more buyers step into the market again and push price up. So now buyers when it gets here, sellers step into the market, buyers leave the market, sellers step into, just like that, price drops. Now it drops. Let's say for example now it's at 1,000 naira now. The 1,000 people are saying, I can never buy it at there, I can never buy it there, I can never buy it there. Now people be like, now it's currently at 1,000, and this has been happening. Like I said, like one thing about trading is we doing technical analysis. Technical analysis is what has happened in the past is going to likely tell us what is going to happen in the future. So now the buyers at this point, they've seen that price came here, it never got back to 100 naira, it pushed above, right? It came back here, it never got back to 400 naira, it pushed above. Now currently it's at 1,000. They know that it can't get back to 700 or 400 naira, so let them just buy it at once. So they buy it and price continue going upwards. So I hope this makes sense. If this makes sense, drop number 5 in the chat box. If this makes sense, drop number 5 in the chat box. If so far what I've been explaining makes sense to you, drop number 5 in the chat box. Drop number 5 in the chat box. Drop number 5, drop number 5, drop number 5. All I've been saying makes sense to you. Drop number 5 in the chat box. Drop number 5. Okay. 5. Keep the 5 coming in. Keep the 5 coming in. 5, 5, 5, 5, 5. Okay, okay, okay. Okay, so at least people are getting it. So we move on, right? We move on. Now, that is what's happening. Buyers are stepping into the market, pushing price upwards. That is what's happening in the market. Now, in a ranging or consolidating market, what's really happening is indecision between buyers and sellers, right? So now there's no difference between the buyers and the sellers, like unlike the bullish market structure where the buyers are more than the sellers, so therefore the buyers win. So trade is just like a tug of war between the buyers and the sellers. Stronger side gets to push price in the specific direction. So if sellers are stronger, then you see downtrend. If buyers are stronger or buyers are stronger, you see an uptrend. So now in a ranging or consolidating market, you don't get buyers are not buyers are are equal to the amount of sellers in the market. So there's indecision. So price doesn't really push into any direction. That is why I said, as a trader, you have to be staying away from ranging or consolidating market or choppy market. Some people call it choppy. Some people call it accumulating market. So just stay away from it. So this is just basically indecision between the buyers and the sellers. No true direction. The buyers buy from here, come here, sellers push price down. Buyers come back, those same buyers come back, push price up, just like that, like that. There's no true, there's no true, distinction between the amount of buyers and the amount of sellers. Now that takes us to the bearish market structure. The same thing applies. Sellers are more right here. They push price down because they feel that price is now what sellers are doing, they're actually selling, right? Now, for example, let's say the sellers own this thing, and this thing now currently buyers has pushed price up to like from 1,000, from 100 naira, buyers has pushed price up to like 2,000 naira, and people selling and be like, oh no, I think this is a very nice price to sell this thing I have because it has gone up in value. So now sellers sell, more sellers start entering into the market. It's time for us to make money. Let's sell, they sell. Now, when they sell, buyers come back, they sell, close their position, give buyers little strength. Buyers come, push price upwards, and then more sellers feel that, okay, I feel it can never get as expensive as this. So before it drops further and loses value, let me sell it. That's what sellers do. Now, more sellers they jump into the market, sell price down. Now, take their profits, close their position, price reverses, buyers step in again. And more sellers say, okay, it was once at 2K, now we go to 1.5. And I feel that probably as it's at 700 or as it's at 1,000, this is the highest it's going to be. It's never going back here. So before it drops in value, let me sell again. So what do? They sell off and push price down. So that is basically what market structure is about. It tells the market so that as traders, we get to make informed trading decision. We get to make informed trading decision. So if this makes sense to you, drop number 6 in the chat box. Drop number 6 in the chat box so we get to move on. I want to make sure everyone is carried along. Drop number 6 in the chat box. Drop number 6 in the chat box. If this makes sense to you, drop number 6 in the chat box. Drop number 6 in the chat box. W's. This makes sense to you, drop number 6 in the chat box. Number 6. Number 6. Number 6. Number 6. Okay, this makes sense. This makes sense. All right. Okay, so currently this makes sense to a lot of people. Now, moving on. Okay, 6. Okay. So now this makes sense. Now, like I said earlier, inside this, this impulsive move, you also see smaller market structure, but then on a different time frame. You understand? So that's how price moves. Time frame is a different time frame, tells us basically the same story but different representation of it. So now, if let's say this black one now that is here, this black diagram that is here, let's say it's the 4 hours chart or the daily chart. Okay, let's say the daily time frame. It's the daily time frame. Like if you don't know what time frame is, I suggest you check our previous live session about time frame. So this impulsive move, let's say it happened on the daily time frame. Now, if you go down to smaller time frames like the 4 hour or the 1 hour time frame, you see, this kind of, smaller market structure inside of this impulsive move. You see an impulse, corrective, impulse, corrective, impulse, corrective inside of just this impulse move. And if you go down to smaller time frame, still inside of this smaller impulse move, you still see smaller, smaller market structure inside of it. So let's head to the charts. Let me show you guys what I'm talking about. Let me show you guys what I'm talking about. Let me take off this session break, these lines, so that it doesn't get confuse us. Okay, which chart should I use? Let me use GBP. Currently I've taken so many trades on this day. Okay, let me see if I can hide everything. Okay, yeah. So now you can see the market structure you're currently seeing on this chart. Tell me what market structure you're currently seeing. Drop it in the chat box. Let me know. Let me know if maybe with that little explanation you're able to catch something. Let me know the market structure you're actually seeing on the chart currently now. Let me know the kind of market structure you're actually seeing. Let me know the kind of market structure you're seeing on the chart. Drop it in the chat, drop in the chat, drop in the chat, drop in the chat. Let me know. Let me know the exact market structure you're seeing on the chart. Let me know the exact market structure you're seeing. Let me know. Drop on the chat, drop in the chat, drop in the chat, drop in the chat. Before I move on, let me know if you actually got it. Let me know before we move on. Let me know the exact market structure you're seeing on the chart. Let me know the exact market structure you're seeing. Let me know the exact market structure you're seeing on the charts. Let me know the exact market structure you're seeing. Let me know the exact market structure. You guys all know the exact market structure. Let me know the exact market structure you're seeing or the exact trend you're seeing. Let me know. Okay, let me make it see. Is it actually going upward or is it actually, going downwards? Let me know. Okay, bullish. Someone said bullish structure, bullish market structure. Yes, exactly. So you guys are actually following. So now you can see now market created a higher. Let's start from here. Creates a high, drops, creates another high, a higher high, creates a higher low. Okay, this high is not higher than this previous one, so therefore this is the new higher high, higher low. And let me extend, and then you see a higher high, higher than this previous high we had here, higher high, higher low. This is higher than this. Let me see. Wait, let me zoom out. Let me see. Okay, see. New higher high. I'm sorry, I've been taking trades on these charts. That's why you guys are seeing a whole lot of this on it. Sorry, maybe next explanation, I'll use a clearer one. So you guys can see it's creating new highs, higher low, another high. Now, see this low right there was lower than this low, and then reversed, created a new higher high, and just like that. And now very soon this high is going to be taken out, giving us a new higher high. So now that is it. Now, basically what I've been saying, buyers are actually current in the market. Now, this is on the 1 hour time frame. You can see the impulsive moves. Now, inside of these impulsive moves now that you're seeing, this is those smaller moves I'm telling you about. You can see, I don't even need to go down to a smaller time frame. You can see another impulse, higher high, higher low, higher high. Correct. And then another one, lower high, lower low, lower high, lower low. Correct again, higher high, higher low, higher high, just like that. Lower low, lower high, lower low, lower high, lower low, and then reverses again, higher high, higher low, higher high, higher low, and then a higher high, and then just like that, just keeps. So that is basically what I'm trying to tell you guys, that inside every impulsive move or every corrective move, you still see smaller market structure inside, smaller market structure. So the common mistake beginners make is that now they feel, now if you check this, this chart I'm showing you guys, this chart. Let me pick away this one. Okay, let me just hide it. Let me just hide all of them. Okay, now if you check this chart I'm showing you guys, you can see that this is not actually perfect. You can see it creates high drops like this, high, some higher are not higher than the previous high. That's how it is. But then now what I want you to do is look at the bigger picture. If I go down to the 4 hour time frame now, let's see the bigger picture. Now let's see the bigger picture. You can see this is the bigger picture. This is what's happening. You can see. So this is where the uptrend started from. This is where the uptrend started from. Now, before the uptrend, there's a market structure I'm seeing right here. And it's the ranging market structure. I don't know if you can see it clearly. I don't know if you can see clearly. Right here. The ranging market structure. Okay, let me just hide it. Right here. You can see it gets here high, just like that. Just going sideways, sideways, sideways. No true direction. It's just ranging. Oh, the range started from here, sir. Started from here. You can see started from here. Started from here. It was flat. Market was basically flat. Gets here, comes flat, 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 flat before it continues. So this is an uptrend. Now let's take it further back. If you can see, other trend. Okay, basically this trend since inception has just been trending upwards. That's how this pair is. It doesn't mean we can't still sell in trend. We also sell during the corrective move, but that's class for another day. That is a class for another day, right? So far, what I've said is making sense. Drop number 7 in the chart box. Drop number 7. Yes, it's going upwards. It's going upwards. It's going upwards. You drop number 7 in the chat box. Drop number 7 in the chat box. If what I've said so far makes sense to you, drop number 7 in the chat box. Drop number 7 and let's move on. Drop number 7 and let's move on, because we still need to cover key levels. Number 7, number 7, number 7, number 7, number 7, number 7. Okay, it's pretty making sense. It's pretty making sense to almost everybody. So now, excuse me. Now let me look for another pair. And let's see if we see a downtrend. Okay, let's see Bitcoin. Bitcoin is dropping. So let me see. Let's use this one. I think there's nothing. I'm going to use this pair for analysis. So it's basically clear. Oh, Bitcoin has a little bit of downward trend. Let's start on daily time frame, so we get to see the bigger picture. Now, like I said, time frame is just basically representation of what's happening in the market, but different, same representation, same story, but different representation of what's happening. So now you can see Bitcoin started trending from here, started going upwards, right? Going upwards, came here, ranged a little, consolidated a little, consolidated, posted in a direction, got up here, dropped a little, got up. Now market structure has changed. Now it's not bearish. You can see it has been creating higher highs and higher lows. Now it has created a high, a higher low, sorry, a lower high, and now it has created a lower low on BTC. This is BTC USD. So that is basically how price moves. It has different sessions. Might be trending upwards, and then reverses, start trending downwards. Now, all these things now is just based on sentiment, right? Over time to make sense. Now, when people are greedy, they buy more, right? When people are greedy, they buy more. And then when people are scared, they start selling, right? After buying and holding it, they start selling it. That's when they are actually scared. So that is basically what's happening on the BTC charts, right? That's basically what's happening on the BTC chart. So now let's go down to smaller time frames so that we get to see smaller trends. Let's see smaller trends. Let's see smaller trends. Let's see smaller trends. Okay, let's start the trend from here. Okay, so currently you can see creates a high, higher low, higher high, higher low, higher high. Wait, wait, higher high, right? And then BTC USD, yeah, BTC USD. And then drops, consolidates for a while, and then finally drops, create a lower high, lower low, and then after creating a lower low, creates a lower high, another lower low, lower high, lower low, and then start ranging. You can see it's ranging right here. So that's basically how market moves. In uptrends for a bit, range, hesitate, bust up in the direction, continues, hesitate, accumulate, bust up in the direction. So that's how it is. Like you can see right here, trended up, hesitated, and then finally busted down, chose the direction we wanted to be going. Same thing happened here. We go here, hesitated. Now it has busted, changed direction, continue trending downwards, giving us low highs, lower lows, lower highs, lower lows, lower highs. I don't know if you can see, don't worry, I'll zoom in. Lower highs. So that's basically how the market moves. So you guys can see, like I said, it tells us the direction, right? It tells us the direction of where prices go. So that is it for the market structure. That's it for market structure. Hope this makes sense. If it makes sense, drop yes in the comment section. If it makes sense, drop yes in the chat box and let's move on. If it makes sense, drop yes in the chat box and let's move on. If it makes sense, drop yes and let's move on. If it makes sense, drop yes and let's move on to what we have today. If it makes sense. Okay. Okay, makes sense. Okay. Making sense. Okay. So now the next thing we are going to be talking about is key levels. Right? Key levels. That's the next thing we're talking about. Key levels. Like I said, market structure tells us direction. Key levels tells us where it's actually occurring. Right? So now what are key levels? Now, key levels are significant levels, or point of interest, as some traders might call it. These are price where market has hesitated in the past. Now, these are just like points of hesitation where market has made noise in the past. So those are the levels that traders watch for to make informed trading decision after knowing the market structure. Now, let's get to the chart. So that we get to explain. Now, before we go to the chart, we have different types of key resistance. We have support and resistance, or supply and demand levels. They're basically the same thing: support and resistance, or supply and demand levels. Now, we also have psychological levels. Now, what are psychological levels? Okay, let me explain what support and resistance are. Support and resistance are like, let me say, support, like the name implies. Support gives price support. So if price never gets here, it gets support, pushes back up, right? That's how it is. Price comes down, it gets support, pushes back up. Now, what is resistance? Resistance is like a level that is like price gets there, it drops, right? Like when we pray in Africa, it's like every power resisting me from moving forward. Yes, that's what resistance is. So price gets there, it resists, it drops. You understand? So that is it. That's what support and resistance are. Price gets there, it drops. Support is basically like a floor, and then resistance is like a ceiling where price can push, and then eventually it breaks above that ceiling and keep moving, or gets there and it drops. So that is what key levels are, or support and resistance key levels are. So now we are talking about psychological level. Now, what is psychological level? Psychological levels are round-up numbers that, as traders, we pay attention to, right? They are numbers like 5, 10, 15, 20, 25, but currently on market price, right? So I'm just giving you an analogy for psychological levels. like 5, 10, 15, 20, 25, 30, 35. Now let me explain what psychological levels are with an analogy. Let's say you want to purchase this, right? For example, let's say this is sold for 1,000 naira. Now, it's sold for 1,000 naira. If you want to price, for those of you that like pricing, that can price for Africa, if you want to price now, instead of saying sell it for me for 762 naira, just that number doesn't just make sense. Even to you saying it, you price at 750, 800, 850, 900. So that's what psychological levels are. Those are the kind of price psychological levels enable us to, like, catch in the market. So instead of selling for me for 762 naira, 763 naira, tell them 750, 850, 900, as case may be 950. You understand? So that is what psychological levels are. So now, and then there are other types of key levels that traders use, but I don't use that because it's not part of my trading system. So some traders use key levels like support and Fibonacci levels, pivot points, and so on and so forth. There are different key levels, but the one that's supposed to concern you is the one I'm teaching you right now, which is support and resistance and psychological level. Yes, yes. Someone said resistance on my village people. That's so. But then that's no way. I'm not talking about village people right now. I just use that to explain. So now let's get to the chart. Let's look for key levels. So now, key levels are places where price has made noise in the past. Where price has hesitated in the past. So those are the levels we are looking for. Where price has hesitated in the past. Now you can see. Let me take us far back. Now this is a good key level. This gray zone you're seeing here, it's a resistance. This is a resistance because the moment price gets here, it pushes it down. It gets here, it pushes it down. It gets here, it's resisting it. Come back here, it's resisting. So now one thing about price is that the more it touches a key level, the weaker that key level becomes. You understand? The more it touches that level, the weaker it becomes. So now if you want to bust through something, like it hit it the first time, chances of it breaking through is low. You hit it the second time, chances of it breaking is low. You hit it again, and then the chances of it breaking keeps increasing. The more you hit it, the more you hit it, the more you hit it, until finally you bust it. And that was what happened right here. So it hit the first time, 1, 2, 3, 4, and then the fifth time you actually busted through. So that is what resistance are. That's what resistance is actually. So now you can see this is a good resistance level. Price got here, resistance, and busted through. What I've said so far makes sense to you. Drop number 8 in the chart box. Drop number 8 in the chat box. Drop number 8 in the chat box. Drop number 8 in the chat box. What I've said so far makes sense to you. Drop number 8 in the chat box. Drop number 8 in the chat box. Drop number 8. Let's move on. I want to make sure everyone is following. Number 8. All right. 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 Okay, it's making sense to a whole lot of people. All right. So now let's look for the support key level. Now, how do you spot these key levels? I know some of you might be wondering, how do you spot it? Now, with your eyes already, you should know that price has, made noise at a particular area. You know, an area where price is, actually, accumulates, like crowding that area, making noise there. And let's see if you can see a good support key level. Let me stretch it. Okay, now this is a good support level. You can see it here. Price made noise here, pushed up, came back here. You can see this is a support. Came here, made noise, buyer stepped in, pushed price up. Like I told you, key level tells us the location of where buyers are actually getting in. And then market structure tells us the location, the direction of where traders are actually pushing the market. Key levels tells us the location, yeah, where it's actually happening, where the price is actually going on. So that is how it is. So you see, price dropped here, pushed up. and pushed up like that. Now, same thing occurs here. Now, if you check here, you see that there's a resistance right here. Check here, you see that there's a resistance, right? You see that there's a resistance right here. Price goes here. Let me zoom in. Go here, drop, go here, drop, go here, drop. Now, this is basically a consolidation market, it's a ranging market. Now, if you also check well, there's also a support right here. As the price get here, pushes up, gets here, pushes up, gets here, pushes up. So that is support and resistance, or demand and supply. So what support implies that when my price gets to this level, demand is going to get into the market. There's going to be a lot of demand. People are going to be demanding, and when there's lots of demand, price goes up. It gets here supply. People start selling. Sellers jump into the market and push price down until it breaks into a direction. So this is a good example of both support and resistance, and also the ranging market. So now, same thing occurs here too as well. You can see support. Market will always keep giving you these levels to trade. So that's why when I call out my trade on the Telegram community, it's not magic. These are the things I watch out for, and then I get to like make my trading decisions. These are the things I watch out for. These are the things I watch out for. These are the things I watch out for if I call my trades. Now, there's something I want you guys to know. Whenever price breaks a resistance or a support, it comes back to retest that support level or resistance level. Now, what does that mean? Price breaks it. Now, price has been using here as a ceiling, right? Breaks it, uses it as a ceiling, drops. Now, the moment price breaks above, it's going to use it as a floor right now, as a support to push up. That is how it is. That's how it is. So when price breaks a key support level, you don't rush into buy. You wait for price to come back. Maybe come back, tap on that key resistance, turn it as support, and then buy. You buy, get in for a buy and push the right price. So that is how it is. Now let's do more example. Let me take us to another chart, like let's see GBPJPY. GBPJPY. Let me take us to another chart. And then we reset price scale. So you can see, okay, now you can see this is a key level. This is support level right here too as well. You can see. Now you can see the moment price broke above this one, it used it as support and busted upwards. So that's how it is. That's how price moves. That's how price moves. That's how price moves. That's how price moves. That is basically how price moves. Let's check another pair with cleaner. Okay, now this is USJPY, right? This is USJPY. Hope you guys can see my screen. Hope you guys can see my screen. We just finished doing XAUUSD. We just finished XAUUSD. You just finished. So now I hope you guys can see my screen, right? So currently, right now, you can see now price will always come back to support and resistance level, and buyers get in or sellers get in depending on the level it is. Now you can see this is never where it started the hesitation. Started reacting on this level from here by extending it. So sometimes where traders make mistakes, they feel that price must come directly, like cleanly, and test on this level. Support and resistance is treated generally as a zone, right? Not just a normal line. Now, when you understand that, you get things become easier for you. Now, some people might say, "Oh, price has broken here, so therefore it's time to sell." But no, it's a zone, an entire zone. You can see it's an entire zone where price has been hesitating. So some traders draw their zones very big, but I don't really need to do that because I already understand how price moves. So sometimes my zones are as tiny as this, and I like it because it doesn't overcrowd my charts and everything. So now you can see price got here, rejected, top here, and then pushed up, and then now it came here. You see, it didn't even break below this. It didn't even get here again. Came here, pushed up again. So that's just how it is. Came here, pushed up again. Came here, pushed up. That is just how it is. That's how price move. That's how price move actually. So that is what support and resistance does. So you guys will do your due diligence, look at the charts, and start marking your levels. Trust me, it gets easier the more you do it. The more you do it, it gets easier. The more you do it, it gets easier. So you can see price gets here, hesitates, gets here, drops a little, breaks above it, use it as support, pushes up. That's our price move. Now, this is on the daily time frame. If I go down to the 15 years time frame, you see that this level exactly, you see how clean it is, how big the structures are. You see how big the structures are. Okay, now look at that level I was telling you guys about. You can see price breaks above, hesitate, drop, hesitate, drop, hesitate, breaks above, support. Now, here, now this is a trade I called. This is a trade I called. What day was this? I think this was on Monday on the 2nd of February. So this is a trade I called in Telegram comments. You can see. So now you can see how I called the trade from here because I knew that price has hesitated and this is a point of hesitation. Whenever price broke above it, so anytime price comes back here, it's going to be pushing up, right? It's going to be pushing up. So I knew that okay, it's time for price to push up with not just with support and resistance, but other things I added. It gave me proper confirmation that price was pushing up, and we'll be talking about that pretty soon as the class goes on. So the next key level we are going to be talking about is psychological level. Psychological level. So you guys should pay attention to what I'm about to say right now. Don't worry, there'll be room for questions. Someone is saying questions. There'll be room for questions, right? There'll be room for questions. So now the next key level we are talking about is psychological levels. Now, if you can see these lines right here, this black line, they're basically my psychological levels, right? And let me take us to BCC. Let me take us to BCC charts. That's very, very free, so that we don't get distracted by all those stuff, all those things I'm trying. And it's this and get rid of it. So now, what psychological levels are? Psychological levels are round up numbers. Now you can see, okay, Bitcoin is actually open. Now you can see Bitcoin is at what's the price currently? It's at 7,903. Now, how do I play my psychological level? I pick my horizontal line to trading view, and then go to settings, and then edit it to 70,000. 70k, yes, and then you see it goes to 70k. Now if you take a clean look at this, you see that price reacted on the psychological level right here, broke above it, reacted here. Now this is an entry to buy again, but then I don't just use this trader, these levels individually. I combine them together with support and resistance, psychological levels, and some other things I add to candlesticks also. So now you see price came here, broke out this 70k. Now if I do 70,500, let's do 70,500, you see the price reacted there somehow. 70,500. Let's do it. You can see now 70,500. Now we can comfortably buy from here and expect price to stop loss here and expect price to go up in value, right? Because now psychological levels are round of numbers. There are levels that, but there are prices that people will want to buy from. Like I said, when you want to purchase something, right? When you want to purchase something, if this is 1,000 naira, you will start pricing them from 962 naira, 961 naira, 942 naira, 43 naira, or 947 naira. It doesn't just make sense because it's not an easy number to remember. Start pricing from 950. You want to give it to me. You want to give it to me at 950. You want to give it to me at 850. So that's basically what psychological levels are. Traders actually pay attention to those levels. Banks pay attention to these levels, to these prices. Now you can see already, if we got in on this trade, we would have already been in profit right now. You can see price has already pushed from where we entered. It's pushing upwards, and it will continue going upwards. Because it's a level that people, once price gets there, people want to watch it. You understand? It's a decent level. Price gets to 70,500. You see, at first it got to 70k, and people bought, push price up. Now, as a bought, push price up, they took profits. Seller stepped in again, drop price. Now we got to 70,500. Buyers got in again, and now they are buying price. So that's basically what trading is about. Already you have knowledge, and from what you're seeing on the market, you know that okay, this is more likely to happen next. So now with what I've seen and current market structure, I didn't just apply. Maybe you guys might think maybe it's just I just said psychological level and then I knew it's going to go up. No, I've already seen the market structure right here. Can you see it? It's already bullish already. Bullish already. So therefore, and if you check it now, if you check properly, you see that market has hesitated here. And this is a key hesitation point, and you can see market has broken it. That is it. I don't really need to draw these things to know what is actually happening. But for you, just have to draw it. Currently, I've already seen it. Came here, drop, came here, drop, came here, drop. Now market busted above it. Came here, retested, came back here to reclaim the zone. And buyers are stepping in. So you can come back maybe by tomorrow or next, or whenever you come back, or a few hours time and check what's more likely to happen is price goes up. That's what's more likely to happen in the chart. So that's how we get into analysis. Pretty simple, right? That is it. Trading is pretty simple. Price action, exactly. Price action. That is price action. That is price action. That is it. Pretty simple. Based on, don't worry, trust me, it gets easier over time. I didn't start like this. It gets easier over time. Over time, it becomes easier. So already I knew that this has happened, this has happened. So therefore, I just get in. It's just like it's now second nature. You know, this has happened, this has happened. So this is likely to happen next. So that's just second nature. So now we've talked about covered psychological levels. Now let's do a more example of psychological levels. Let's do 60. Let's do okay. The last one was 70K. Let's do more down. Let's say 60. Okay, 69,500. 69,500. You can see price will definitely react there. You can see price reacted here, reacted here, reacted here. Seller steps in before buyers came and then push price up. And if you do 69K now, do 69K, you see that there's a reaction there at 69K. So these are like round up numbers that banks and everybody pay attention to, because when you want to buy something, you need a number that you can actually pay attention to. Okay, now look at 69K. You can see price rejected. If you don't know what price rejection is or a candlestick rejection, check the previous video. You can see price busting up. That's basically how I get the trade. That's basically how I get to call out this trade for you guys. And some people will be like, guy, are you sure you're not doing magic? It's not magic anything. It's just the right knowledge, which I'm here to show you guys. So you can see he hesitated. Now this is another good time to buy. If I was earlier on this market, I would bought from them. My stop loss here. 2:1:2. And you can see we would have hit take profit and would have all made money. So that's just how I get to call out my trades. Pretty simple, straightforward, straight to the point. No need for too much stress or anything. So that is it. That is how price moves. Psychological levels. Exactly. This is real world. This is real world. Exactly. So now the next thing we're going to be talking about. We've already covered the lot. We've already covered the lot. Now, let me just give you guys the importance of key levels. Now, the importance of key levels, like I said, they show us the location. They give us the location of where the bedroom is happening, where the party is happening. Like, go and buy at that point, or go and sell at that point. That's what key levels help us to do. And they add context to candlesticks. That is what they add context to candlesticks. Like I said, nothing actually matters without candlesticks. Like I mentioned in previous candlestick class, that candlestick doesn't just say something like that. It doesn't just tell us. It's not just candlesticks are not just used like that. Now they are used with context, and context is key levels. Now you can see I talked about rejection somewhere around here. The price rejected, pushed up, rejected. Now what's this candlestick pattern telling us? That buyers are stepping into the market little by little. So what is the next thing to do? Join them to step into the market and buy. And then you can see now this is the price rejected, candlestick came here. You can see price is really doing so well. It's already in profit. If I enter this trade, I know how much I would have been up right now. So that's just how it is. That's just how I get to call out the trade. So that's the importance of key levels. And then the next importance is they reduce noise on the chart. They reduce noise. Now, when I say they reduce noise, right? Now, get to sit on the chart all day and waiting for and be looking. Just mark your key levels and just wait for price to get there. And once price gets there, you execute, you react. That's basically trading. Wait for price to react, wait for price to act, and then you react. So that's just it. Wait for price to act and then you react. So that I can see price is busting up aggressively. That is how we trade. That's how we trade. Day in, day out, day in, day out. You see, forex no easy. See, forex no easy. Just me gets the more you do it, the easier it becomes. The more you do it, it becomes second nature, right? It's something you don't really basically have to like, crack your head again. You just like you breathe it in, you breathe it out. That's just how it is. So now the next importance is they show where decisions are made. Like I said, they show you where buyers are getting in or where sellers are getting. Like I explained in those examples on the chart. You guys saw it. But that's where buyers are getting in. And then how traders use key levels. Now traders use key levels like just to, get into, you know, like the best price or the best time to actually get into the market. So they show areas of interest, like where you are interested in. Like psychological level now shows like the price you're interested in. Let's say price gets to like 70,500. And so when it gets to 70K, I'll buy because it's definitely into that price moves psychological level to psychological level, price to price. You always see a reaction. Just go and plot your psychological levels. You always see reactions, and don't review psychological levels on different pairs like gold, GPUSD, so that you guys don't get confused. Now, there are confirmation zones. Like I told you, psychological point of hesitations or key levels are confirmation zones, right? Key levels are confirmation zones on where we get to enter our trades. So that's just how it is. That's just how it is. So I think we've basically come to the end of today's class. But before I put rooms for question, if I open the room for question, let's cover a little bit more psychological levels on pairs like GBP USD. What pair is this? Okay, a GBP JPY. That is the British pound Japanese yen. So this is the British pound against the Japanese yen. Okay, you can see my psychological levels right here. Let me hit it properly. Two, 1, 3, 5, 7, 5, 0 here. Okay. Now you can see Bitcoin is in the thousands of dollars, but this one is just 213.500. So that's just how it is. Like different pairs, different way of using psychological levels. Now I'm going to show you how to know if your psychological level is actually correct, right? If the psychological level you plotted is actually correct. Let me get rid of this, let me get rid of this thing right here. So that you get understand, okay? Okay, now see. You can see the moment price, but price came here, right, at 213.00. Let's say 213. We reacted here, buyer stepped in, pushed it to 213.50 right here. You can see 213.50, and then you reacted. Now this reaction means sellers just steps in and more buyers are getting into the market. So that is it, and then price bust up. And if you put more psychological levels, let's say okay, 2113, next one should be 2114. Next one should be 214.00. You can see price has gotten here now. The next place price is going to is 214.50. Let's add it up. So that's just how it is. I just add psychological levels and then wait for price to react on those levels and add some other confluences, and then I get to catch my moves. That's how it is. That's how it is. It might not make sense currently, but maybe over time just revisit the video and it actually makes sense. So you can see price reacted here little, and then to bust up again by the time the market opens on Monday. But Bitcoin is open because it's a 247 market. But pairs like gold, XAU, USD, it's a 245 Monday to Friday. It's 5 days a week. Monday to Friday. But unlike crypto is open Monday, like day in, day out. It's always open. So you can trade at any time. So that is how it is. 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 So you guys have seen. Okay, let's do one more psychological level example on gold. Let's do it on gold. Right? Let's just do it on gold. Let's do it on gold. Now gold is in course gold is about, that's the current price of gold. Gold is about 4,900. So you can actually plot the psychological level here. It's 4,900. Let's edit it. Go to settings, and you can also do this on your phone too. You can download trading view on your phone. If you have a PC, that's fine. That's even the best for you. You can see, okay, this 4,900. The next psychological level should be 4,950. 4,950. 4,950. And now you can see price go here, rejected, pushed up. That means buyers are stepping in. Now, by if gold was to be open, I would have taken this trade. My stop loss somewhere around here and catch this move very fast, very fast. And do 1:2. And when I mean 1:2 is your risk to reward ratio. That means if you're risking $10, you're looking to make times two of that $10. If you're risking $1, you're looking to make times two. So whatever I'm risking, let me see if I open this trade, I will have be risking about $44. And I'll be looking to make about $88 to $90. You can see this stuff right here, risk reward ratio is already showing 2.02. So that's just how it is. Some people might do more. Some people might do 1:3. Some people do 1:5. Some people do 1:10. Those people, I don't know. They do 1:10. So that's how psychological levels are plotted. Now, if you want to know if your psychological levels are actually correct, once plotted, there's a measuring tool, which is this date and price range. Now, psychological levels are 50 pips. Now, you guys should remember what pips are. Stay with me right here. Pips now, they are market movements. Like last previous classes, we've covered what pips are. Pips is like the same way humans are movement are calculated in steps, market movement is calculated in pips. So that's how it is. Now, if you check, it's 50 pips, 50 market movement. Let's measure it. Let's measure it. Let's measure it. Let's see. It's about 49. Wait, let me zoom in properly so that. Okay, I didn't get it up here right perfectly. Hold on, what's up? So amounts are sweaty. Okay, let me just get here. You can see it's 50 pips. Go to PCC. PCC, let's go to PCC. Let's go to PCC. Wow. Wow. Sorry, mouse, my hands are sweaty, so the mouse is kind of resisting me from using it. The mouse is resisting me. Now let's measure this psychological level. Can you see? 50 pips. It's 50 pips. 50. Can you see? Okay, this one is about 500. And yeah, that's because Bitcoin moves differently. Now, if you go to gold, let's say USD, check it. Same thing. Same thing. 50 pips. Let's go to which other pair did we use though? JPY. Okay, yeah. Well, there's our psychological levels here. Check it. 50 pips. Let's just do it. 50. You can see right here. 50 pips. 50. So that's how to know if your psychological levels are correct after plotting them. For those of you who might be new to plot psychological, but me, I don't actually need this stuff, right? I don't actually need. So now it's time for questions, right? It's time for questions. I think we've already exceeded our time right here. It's time for questions. So, all right, hit me up with your questions so that we bring the class to an end. Hit me up with your questions. Hit me up with your questions. Hit me up with your questions. Let me know. Let me know if you have any questions. Drop it in the chat box. Let me know. Let me know. Let me know so that we get to end the class. Okay, so end the class. Let me know. Let me know. Let me know if you have any questions. Let me know. 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 Let me know if you have any questions concerning what I've covered today. Or everybody understood everything, so that nobody's asking questions. That the class was that's so straightforward. Let me know if you have any questions. If you have any questions, okay, since you guys don't have questions now, I think this is actually going to be the end of today's class. Let me wait a little. Okay, someone asks, what if a zone acts as both support and resistance? What do we call it? Now, zones do act as support and resistance. Like I said, a zone will act as a resistance, resist, drop, resist, drop, resist, drop. Okay, wait, you guys can see me. A zone will act as a resistance, resist, it drops, resist, it drops, right? It resists, it drops. And then eventually, like I said, the more price touches that zone, the weaker it becomes. And then eventually it just breaks it. And once it breaks above that resistance zone, it becomes a support. Now that zone now, the moment price breaks above it, it's no longer called a resistance zone. It has flipped. Price has flipped that zone from being a resistance to being a support. So now it's no longer called the resistance, but a former resistance now currently support. Now same thing applies when it's a support level. Price bounce above it, goes up, bounce above it, goes up, bounce above it, goes up. When it comes back down, the weaker that zone becomes. So eventually it breaks above it, it breaks below it rather, and then uses it now as a resistance. Now the moment price breaks, uses it as a resistance, comes back to retest that zone. Now once it comes back to retest that zone, it drops further. That is how price moves. That is how price moves. So now in that scenario, we see that price has been flipped from support, former support, to current resistance level. I hope that answered your question. I hope that has answered your question. I hope that has answered the question. So is there any other question? Do you guys have any other question? Do you guys have any other question? If there's no question, then I think we've come to the end of today's class. And always remember, today is a new day to become a better you. So trade smart. Make sure you hit thumbs up, subscribe if you're not yet subscribed, and then also share. Share with friends, your family. Share. And I'll see you guys next week, same time next week. All right. So peace out. Bye, guys.